Good afternoon, Trader Tim here from eminimine.com doing a trade recap for Thursday, the 14th of January, 2021. I wanted to run through today and yesterday here in the ES as well as some swing trades, and particularly on the subject of my entries if I'm trading the option versus my entry if I'm trading the stock. So we'll get to that in a minute. First, we'll start with today on the ES. And if we zoom in here to the 5-minute chart from this morning, I ended up with no trades today in the ES. And the reason why was because early on, shortly after the open here, we failed a halfway back long, meaning we came down and broke the 61.8. And when we did that, I got rid of that drawing. So I didn't have a limit order resting here because it was the 5-minute drawing, meaning I drew it up here on the 5-minute chart. I'm essentially waiting for support to be shown. There was no support shown, so there was no entry to place. So when that long failed, I turned around and drew the short from highs to lows. And this one also failed. Now, here, we did have a nice touch of the halfway back short, but we did not come down and break a swing low. So there was no entry there. And then the second touch, same thing. We retested the 50% short, but we weren't able to come down and break the swing low, which is kind of the line in the sand that I would use to take an entry. So when we have the back-to-back failure like that, where we have a long break at 61.8, and then you draw up the short next, and it breaks its 61.8, I stay out of the middle of that range. So what that looked like, if I kind of draw up, and we'll call this a no trade zone, it looked like this. And so the rest of the day, or at least the morning session, we just hung out within that range. We got a little poke above highs. Didn't really get a strong setup here, and this week I'm passing on shorts, or at least until shorts start to look a little bit better. But last week we really did not have any strong short setups. Every short was just blowing through, so that's just a way for me to prevent getting faked out intraday and just taking unnecessary stop outs. So when you have the two failures like that, look for a break above the highs or below lows of those high and low anchor points, and stay out of the middle of that range. Now if we go to yesterday, a little bit different story. The first one, the first setup actually ended up being a short, but like I said, passing, I think it was drawn like this. Let's take a look at the 512. Passing on those shorts has kept me from taking unnecessary stop outs. Oh yeah, so it ended up looking like this. The first short did work out right off the open, like 10 minutes in, but then the second one, when it was, getting towards the 15-minute mark and looking for my first trade setup of the day, I chose to pass on the short here at 37.9250, just for the fact that I had not been seeing shorts work so far this year. Every bit of bearish news is being shrugged off. Every bit of short-term down move had been bought up. And so even if you look at this, 1 bar sell-off, we immediately rallied in the very next 5-minute bar. So the long, couple of longs actually, but the long after the short break, so if we were to draw up, let's see, it was 840. So we had this big halfway back short here that there was no stopping at. We just went straight through it. There was an opportunity to take a long off of, we had this double bottom, so the short broke and then immediately formed this double bottom. There was a nice little long entry there, quarter after. There were a whole bunch of, you could pretty much pick any of these halfway backs on the move up. And so going with that trend, with the uptrend, I mean, any of these were buyable. I took one at 8:40 my time, and that was a 97.75. If I come in and just mark the top of the first 30-minute range, that'll give me a better indication here. Yeah, so it looked like this. Whereas the 50% lined up with the top of the first 30-minute range. And actually, I think my anchor point was more like that. So pretty much any of these halfway back longs, being the uptrend, the longs are with the trend. If you skip that one, you can take the next one, trade it in a tick or two beyond the 61.8, but it worked out just fine. Any of these are fine. And then this long, so what I did was just trail. You use the -23 as your first target, then just trail the swing lows on the way up, and then once we come down and break a swing low, you get taken out. So pretty straightforward as far as the trade management goes. But the key is you got to be hands off and stick to your trail stop plan, and don't just come in and micromanage it and think, well, we've traded high enough, we can't go any higher, I'm just gonna flatten out of the trade. Shifting over to swing trades. Now, Netflix set up in a hammer pattern yesterday, or 2 days ago, and this is a pattern that I trade a lot. Hammers and inverted hammers. And so if I'm trading the stock, the market pulls back. If I'm trading the stock, I'm going to wait for that candle to completely close. I'm going to mark the high of that candle, of this red candle here on the 12th, and I'm going to enter on the next day in the morning. So 501.09 was the high for Netflix on the 12th. So just putting my entry at like 501.15 or 501.20, just a few cents above highs, and entering the next morning. So then same thing goes for, like, on the other side of things, GILD set up in a short where it broke the low of this high bar here. Not quite an inverted hammer, but we were going up, 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 up. We broke on this bearish engulfing candle. And so the signal bar being the 8th and the entry being on the 11th when we broke below the prior day's low price. Then the other one I got here is Peloton. This was a real beauty, and this guy even set up at a nice 50% long. So you can see the 2-leg pullback, 1 leg down, tiny little bounce, 2nd leg down. We bounced, we broke the swing high, same concept as intraday. We ended up pulling back to the 50%. I don't always use 50% on or most of the time, I don't use 50% on swing trading daily charts with individual stocks, but it's always nice when you get a little bit of extra confluence here. But looking at the chart, where are we going to draw the entry? Well, it's going to be a few cents above the high of this hammer candle, so entering the next morning. Now this one, for the stock entry, it actually started moving quickly off the open, so you may have, you don't always get if it gaps up or if it moves fast. 157, I think 41 is what I wanted, and ended up getting filled a bit higher than that. But nonetheless, the idea is you get these strong pushes up following the hammer, and on all these trades, my stop is below that candle's low, or in the case of a short, above the candle's high. So that's how I enter these on the stock side of things, and then just trailing my stop once we pull back, putting my stop underneath the next swing low. So like, let's say I got long above this hammer here, like that. Well, once we pull back, you go 4 or 5 days up, I move sideways or pull back, and then you go up again. Well, then I can take my stop from underneath the swing low here and move it up underneath this swing low. And that's a really easy way to just kind of manage your stop, but giving it enough room to pull back and not just get stopped out right away before it has a chance to get moving. The other stop placement you can use is putting your stop below each candle's low every single day. That's a great way to be a little more aggressive with your stop. But now let's look at those same stocks, and I'll talk about where I would enter on the option. Now with the options, I'm just trading directional, keeping things pretty simple. I don't like to cap my upside, so I don't do a lot of spread trading or more advanced strategies. I just keep it pretty simple. And so if you're going to enter the option on the following day on a break above the high price of that hammer candle, you're going to be paying a lot more for it because the momentum is going when you're buying an option, whether it's a call or a put, and you're buying with the momentum, you're going to be paying a premium for the option. The key to getting good option prices is to be buying when the market's down and selling when the market's up. So this is why, buying at halfway backs in the options are great because you're buying as the market's going down. People aren't as interested and excited as for long calls. And then you're selling at a target when the market has rallied. People are excited, so the price is inflated. And that's the way I've had, the most success trading options over, the last 13, 14 years. So with the option, I'm entering on the close, and you risk the market not breaking out. So, by identifying a hammer pattern in a bullish trend, you have a pretty good chance of getting a follow-through day like we had on Netflix here the next day. But in order to get a better price, I like to enter the option at the close, and if it were to peter out, I can just close out of the position, and I didn't pay as much for the option as if I got in the same day or the same time as I would on the stock. Benefit of the stock is that there's no time decay. You can hold it for as long as you want. Downside of owning the stock is that it costs a lot more and you tie up a lot more capital. Benefit of the option, much cheaper, a lot higher leverage, quicker moves. But again, that time decay can, cap some of your gains if the market is not necessarily done going up. So another thing with the option, I'm more interested in taking a quick gain on a spike. So like Netflix, you could be in at the close on the 12th and exit at the close on the 13th and have a pretty substantial win, even if you only have a couple of contracts. I like to buy at the money or close to at the money so that if it does go my way, the delta's moving pretty good in my favor. And if it doesn't go my way, I'm not, I don't have a huge delta that's starting to go against me. So I find that somewhere around at the money, usually the front month or 1 month out. I don't like to pay too much for the options, and I'm expecting a move in the next couple of days, so there's no sense to buy a ton of time. But like I said, I try to keep things as simple as possible with options. There are definitely some drawbacks, but for these more expensive stocks, your FANG stocks, your Teslas, you can really clean up on some of these moves because they're happening so quick and they're so big. So like with Tesla, most of you, we talked about the big triangle back here in November and buying puts buying calls rather on the consolidation. Well, December expiration was right in here. So you're kind of stuck. Even if you hold all the way to expiration, you're not going to be able to capitalize on the rest of the move unless you roll them up or move to the next month. What were the other ones here? Oh, GILD on the short side, same thing. Now this one doesn't really give you a great short entry signal on a close because you don't really have a hammer pattern. So, taking a short on one of these highs at the close, you're really just picking a top. I really need to see, a strong intraday reversal with an inverted hammer or a hammer to go long, inverted hammer to go short. Peloton, though, the other one, we're down here at the 50%. You get a bounce and you get a rally into the close. Definitely worth buying that at the close. Again, mental stop underneath the low of the day, and you can just close out the option. It's still going to have some premium in it. Usually, at least 50% on most of them at the money, even if they go down below that candle's low. I don't use hard stops with options just because it's a little bit harder to calculate. Another benefit with the stock, very calculated, very defined risk. Options, a little bit more of a gray area, a lot more leverage and upside potential in a short amount of time. With the stock, plenty of time and lots of room for the market to run, but it's a very linear market. Goes up $5, you're up $5. It goes down $5, you're down $5. With the option, it could go up $5 and you start to exponentially grow the value of that contract. So with Peloton, same thing. Closing out at the close the next day, at least a couple of the contracts. Let's say you have 5 contracts. Closing 2 or 3 out on the spike, because if the market just moves sideways at the same price, you're going to just be losing time decay over those course of the next few days. And if it just goes a little bit higher, you may not end up even seeing an increase in the option price. So that's how the difference in how I trade the options versus the underlying stock. And if you have questions about that, feel free to drop them in the comments below. And you can always tune in to the Tuesday live trading session. I talk, mostly ES intraday trading, but do talk a little bit about any swing trade positions that I have on as well. So I hope that was helpful. Have a great weekend. We'll talk to you all soon.